Welcome to this latest video in our series on the basics of Forex. In this video, we're going to run through 7 benefits of trading Forex. So do keep watching to the end of the video so that you get to hear about each of these benefits. Hello, I'm Peter Martin with Trading 212. We add educational videos about the financial markets and about trading to YouTube regularly. If you haven't already, then make sure you subscribe to our YouTube channel because that's the easiest way to know when we've added fresh content. Well, there are several important benefits that you gain from trading Forex, and we're going to run through each of these in this video. But what we're going to begin with is one that I haven't really touched on at all in this series of videos so far about the basics of Forex, and that is trading with leverage, or what we call trading on margin. So let's take a closer look now at trading on margin and trading with leverage. Okay, so in our rundown of the benefits of trading Forex, the first item then is leverage. Leverage allows control of a large value of currency by only having to deposit a small amount. And this is what's known as trading on margin. So what we're going to do is to run through an example using dollar Swiss to illustrate how trading on margin works and both the risks and benefits of leverage. What we need to do first of all is to find out what the margin rate is for dollar Swiss, and we can find this out from Trading 212's app. So here we are in Trading 212's web app looking at a chart of dollar Swiss. And if we ever want to find out some information about an instrument, there's a good chance we'll find it by looking over here on the instrument details. So I'm just going to click on there and it opens up this pane on the right hand side of the window. And in the additional info section at the bottom there, we can see margin is listed as 0.5%. That's the margin rate that I use on my account, which is as a professional investor. If we just scroll down a tiny bit further, we can see the leverage there is 1 to 200. So 0.5% margin gives us a leverage of 1 to 200. So our Forex leverage example is going to be for dollar Swiss, the US dollar against the Swiss franc. And as we just saw, the margin rate with Trading 212 is just 0.5% for that currency pair for a professional client. So that means you need to have deposited for a position just 0.5% of the currency value of the underlying position. Now, 0.5% is 1/200th. So the leverage is 1 to 200, i.e. $1 in margin is going to command $200 in underlying currency value. And to give you a visual representation to try and illustrate this point, let's say that you use $1,000 as margin. So that's represented by this highlighted section here. That's the $1,000 that you've deposited on your account. Now, for simplicity's sake, I'm just talking about dollars here because that's the base currency for a dollar Swiss trade. But of course, the margin you deposit to your account would be in whatever currency your account is denominated in, say pounds or euros or whatever. Now, the leverage for dollar Swiss is 1 to 200, as we've just seen. So you can take a position that's 200 times larger than this amount. So you could take a $200,000 position, that's represented here by this much larger section. You could take that position in dollar Swiss just by putting down that $1,000. We do have to be clear here though. Trading on margin offers the convenience of putting down a small amount in order to command a much larger exposure. But it is vitally important that you are aware at all times of the size of that underlying currency that you are commanding and that you're aware of the risk that it entails. So let's just run through some very simple numbers to further illustrate this leverage example. So we said you could take a position of $200,000. Let's say that you choose to buy those $200,000 of dollar Swiss at an exchange rate of, let's say, 0.9792. And let's say that the exchange rate increases and you're able to sell out your position at a profit. So you sell $200,000 of dollar Swiss at an exchange rate of, let's say, 0.9802. Now, 1 pip for dollar Swiss is 0.000 1. So 1 pip is the 4th decimal place. And so this is a 10 pip increase in the exchange rate, a 10 pip profit for you. And when we say 1 pip is 0.0001 of the exchange rate, that exchange rate is an expression, of course, of the number of Swiss francs that you get per unit of the base currency, and the base currency being US dollars. So that 1 pip is 0.0001 Swiss francs per US dollar. So your profit is a $200,000 transaction size multiplied by that pip value, multiplied by the number of pips you made. And so your profit, if you work those numbers through, works out as 200 Swiss francs. At an exchange rate of 0.9802, that's roughly about 204 US dollars in profit. Now, if we were to take that $204 profit and then compare it to your $1,000 margin deposit, the profit is greater than 20% of that margin. And now if we think of an unleveraged version of the trade where you actually took 200,000 US dollars and converted it into Swiss francs and then back again for the same number of pips profit, then the $204 expressed as a percentage of that 200,000 is going to be around about 0.1%. So we can see that the effect of leverage is to amplify your profits, to magnify them. But this does cut both ways because it can work this way in terms of loss as well. Now, if we consider the same trade, but this time as a 10 pip loss instead of a profit, then the margin would be $1,000, the same as before. The P&L expressed as US dollars is $204, but this time it's a loss instead of a profit. And then that loss expressed as a percentage of the margin you put down would be greater than 20%. And if we consider that once again to the unleveraged version, where you were just simply converting 200,000 US dollars into Swiss francs and back again, then that $204 loss expressed as a percentage of the full 200,000 would be around about 0.1%. So there you have that 1 to 200 leverage, and it has magnified your losses in this case. So it cuts both ways. As I said before, in terms of P&L, it is always worth bearing in mind the size of the underlying value. If you are conscious of the risks, it can be a very convenient way to trade, because in this example, you wouldn't be tying up all this 200,000 in order to gain that $200,000 exposure. So having worked through the numbers for the margin rates for a professional client, I should point out that the leverage is lower for retail clients, and that's just there as a protection in terms of that risk aspect that accompanies higher leverage. So the margin rates with Trading 212 vary according to whether you're pro or retail. And for dollar Swiss, the pro rate, as we said, was 0.5%, and the retail margin rate is 3.33%. So that's a leverage of 1 to 30 rather than that 1 to 200 that we got for the pro account. Now, all accounts with Trading 212 start out classified as retail, and you can switch to professional on request, subject to trading experience. So we've now covered trading on margin trading with leverage. Let's now run through the 6 other benefits of trading with Forex. So number 2 in our list of benefits is that you can go short as easily as you can go long when trading Forex. Forex trades are inherently two-way, and as I'm sure you've gathered if you've been following our Basics of Forex series, if you trade a currency pair, there are 2 currencies involved. For example, the US dollar against the Swiss franc, which we've just been looking at. Now, whichever way round you decide to trade, whether you're going long or short dollar Swiss, it is inherently part of the trade that you're buying one currency and selling the other. Now, you can go short with other instruments, say CFDs on shares or CFDs on commodities, for example, but you do sometimes experience restrictions on going short. For example, at one point during the financial crisis, the US Securities and Exchange Commission, the SEC, temporarily put a ban on short sales on a list of financial stocks. With Forex, there are no restrictions on going short. If you can trade the pair, you can go short either one of the pair. Number 3 on our list is liquidity. The Forex market is by far and away the most liquid market in the world. Generally speaking, the more liquid a market, the more efficient order execution will be. So that's a nice benefit. And then number 4, 24-hour trading. The Forex market is a truly 24-hour market. From Sunday night through to the close of business in New York on Friday night, you can trade Forex prices. If you want to learn more about either of these, liquidity or 24-hour trading, check out my introduction to Forex video in which I speak in more detail on both of these. Number 5 is the tight spreads that you get when trading Forex with Trading 212. Let's take Euro-Dollar as an example. Euro-Dollar is traded on what's called a floating spread, which means that the spread does vary from moment to moment, but the target spread with Trading 212 is 0.00009 of the exchange rate. So that's 9 fractional pips. It's less than 1 full pip. On top of those tight spreads, there's no commission to pay. Number 6 is that you can trade in small transaction sizes with Trading 212. The minimum transaction size for Euro-Dollar, for example, with Trading 212 is 1,000 euros, and that trading quantity is equivalent to 10 cents per pip movement. And number 7, Forex offers access to a wide range of economies. With Trading 212, you can trade more than 150 different currency pairs. And that wide range of breadth offers real flexibility for backing your view. Well, I hope you enjoyed this video on the benefits of trading with Forex. If you did, please take a moment just to tap or to click on the thumbs up button and give us a like. Why not share your thoughts with us in the comments section? Are there any benefits that we've missed out? What do you think about the benefits we discussed in this video? Let us know by sending us a message there. We do read each one. But that's all for now for me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.